Times Influence Initiative.
The 5th edition of the India Economic Conclave, a unique thought leadership platform, brought together policymakers, CEOs and global leaders to discuss key issues related to business, economy and governance. The event saw the convergence of innovative and disruptive ideas which are needed to make India a $5 trillion economy.
So our next guest has the unique distinction of being a global insider. He has a microscopic view of North Block and a telescopic view of the world.
Joining us right now, please put your hands together, is former Chief Economic Advisor, Professor Arvind Subramanian, whose latest offering, Off Council, gives a deep understanding of challenges and management of what he calls the Modi-Jaitley economy. I call upon stage ET-Now's Executive Editor, Supriya Srinath, to take this very interesting conversation forward.
A very good afternoon to you, Professor Subramanian. Thanks very much for joining us. But first up, before I start with my volley of questions, if I may request you, in short, to give us a sense of how you see the state of the Indian economy, both short-term and over the long term, in a world, like we're increasingly saying, is absolutely uncertain.
Thank you. Thank you for having me at this summit. It's great to be here. Let me first talk about the short-term context and then step back. And after all, this is a session about the $5 trillion economy and so on. So I do want to make some remarks on the long run as well. In the short run, I think if you step back and say, over the last 2-3 months, there have been macroeconomic anxieties in India related largely to oil prices going up and US interest rates going up, capital outflows. That of course affected a bunch of emerging market countries, but India was not spared the buffeting from that either. And there was a sense in which there were considerable anxieties. But thankfully those anxieties have receded. Oil prices are down again, the rupee has strengthened, and one gets the sense that that turbulence, that brief period of turbulence is probably now going to be over, hopefully. The associated good news on the macro, of course, is that inflation is down and well below the target of 4%. So in that sense, once again, now the focus shifts in the short run from the macro back to the micro, and there of course the headline is growth has, the latest number showed a significant deceleration in growth, but of course we must remember that it's still deceleration at levels that the world would envy. 7% for example is probably still the highest growth rate in the world. We have to brace ourselves in the short run for some probably further deceleration. My own view for the short run on growth is that bracing ourselves for a slowdown. And of course, we are at a stage in the calendar, in the political calendar, where there's going to be some uncertainty. There will be electoral pressures on both sides. So we have to see how that pans out.
Dr. Subramanian, before I go any further and before I talk really about the macro economy and all of that, we also must not lose sight of our institutions, and I can't not ask you the news question. The markets may have taken it in their stride, the resignation of an RBI governor in a very unprecedented sort of a way. But do you believe the damage has been permanent?
The way to think about this, the way I think about it, is really that one has to focus on the underlying policies, not on individuals and short-term circumstances. I think the outgoing governor and the RBI more recently have embarked on two, I think, very important policy agendas, as it were. One was, of course, restoring credibly kind of the integrity of the financial system. 2018, we made great strides in terms of the bankruptcy code, but 2018 also, threw, to use a cricketing metaphor, many googlies at the financial system. So And I think the RBI had made taken some commendable steps, whether it was the prompt corrective action, whether it was, dealing with the NBFCs, whether it was dealing with, individual private banks. I think there was a very solid agenda there. Of course, there was some oversight in terms of, the NBFCs and ILFS and so on. But there was a very strong agenda for restoring the financial system. And I think what's going to be key is whether this is maintained going forward or not. I think that's what we have to assess going forward, not individuals or current circumstances.
In your economic survey, many people believe, quote unquote, you floated the big balloon of universal basic income. Given the agrarian stress, do you believe it's feasible to look at the universal basic income? Is it feasible to look at cash transfers? And do we have the resources?
Especially in the aftermath of this election, and especially after what's happened in the last couple of years in agriculture, my strong suspicion and prediction is that almost every political manifesto heading into the 2019 election will have some commitment to some sort of universal basic income. Do we have the space for that? I think a lot is going to depend upon what kind of UBI it's going to be. Is it going to be done by the center or by the state? If a state does it, I think actually you probably need less additional fiscal headroom, because the states can tell the center, give us whatever you're giving, but just don't tell us what we should use it for. We might want to use some of it for UBI. So it's going to be dependent very much on where it's done, how it's done, those factors.
On that note, Dr. Subramanian, thank you very, very much for being with us. Unleash your intellectual power on the world and let some of us benefit from it. Thank you very much for being with us and joining us right here on the India Economic Conclave.
It's time now to bring you a voice that matters, and a voice of global repute as well, and an opinion that markets swear by.
What are the fault lines that worry him now is the question. What must India do to ensure a position in the $5 trillion club? Ladies and gentlemen, it's time to tune in to none other than Raghuram Rajan. ETNA's Supriya Srinath recorded this very special conversation with him, and the session is on, Is India Future Ready? Put your hands together for none other than Raghuram Rajan, please.
Thank you very much, Dr. Rajan, for joining us all the way from Chicago. The first question has to be, is India future ready? And what is it that we need to do to get to a $5 trillion economy?
Well, I think that first we must pat ourselves on the back a little for what we've done so far. I think 25 years of 7% growth is a good thing. However, we are approaching middle-income country level, and that means we have to focus much more on getting our growth path straightened out. We actually need more equitable growth. That today, for example, the extent of job creation is something that one must worry about in India. The reports of 25 million people applying for 90,000 railway jobs is something that suggests there's not enough supply of jobs in the market. We also have to worry about the path of growth in terms of pollution, emissions, and so on. And of course, that leads to the issue of institutions. The factor that helps us grow in a healthy way is strong institutions, whether it's the pollution regulator, the emissions regulator, or whether it's the financial regulator. So these are structures that we must strengthen. They have to stand as independent bodies to ensure our growth is healthy and stable.
One of the questions that I want to ask you, Dr. Rajan, is that I think we've been extremely lucky as far as the oil price regime is concerned. At least this government has significantly benefited from a benign oil regime. I mean, from the highs of $140 a barrel, we've actually seen the lows of sub 30. Why is it that the same oil price regime, the benign regime, could not spur our growth further?
Well, I think that's a very legitimate question. Where has the oil windfall gone, and how does it hurt us as it comes back in the form of higher prices? So I think the key issue is the volatility of oil, and especially with geopolitical tensions, volatility is going to increase. So that suggests that there is a very strong need for a oil hedging mechanism for a country like ours, which is so dependent on oil. I think we've discussed this in the past. Of course, we've started a strategic petroleum reserve, but over and beyond that, we have to think about whether it makes sense to hedge the price of oil, especially when it comes to levels such as these. And we must, as a country, think about whether we should start this process.
I do want to take this discussion beyond the realm of just pure economics and, just hard numbers on growth and oil and, investments and things like that, to really talk about issues that will spur growth. And this brings me to the discussion about the education system. What explains an impressive rise in enrollment rate but an equally sharp rise in the dropout rate in our schools and colleges? Is Indian education true perhaps only in pieces?
Well, I think it's not just education, it's also healthcare, because the kind of nutrition, the kind of healthcare that our young get at an early age may in fact stunt them for the future and make it much harder for them to benefit from any kind of education system, let alone the education system that we have. Now, there are some good pieces of good news on education. One is that everybody eventually seems to enter the classroom. Now, whether they continue in the classroom, whether they learn enough, I think is a very different question. And the ASAR surveys, the work that Pratham has done, suggests they're not learning enough, that too few of them are essentially numerate as well as able to read in an effective way. So now that we've got everybody into the system to begin with, let's keep them there by giving them a much better, much higher quality education than they're currently getting. And this requires tremendous work on all sides again.
Indeed. On that note, thank you very, very much, Dr. Rajan, for sparing time and speaking to us on a very important topic. We can't thank you enough for taking time out from a busy schedule all the way in Chicago and addressing some of those questions for us.
Thank you.
So from political power in our last session, we're moving on to another very interesting topic. The Rise with India story would not be complete if it weren't for the faith and conviction that the Aam Niveshak has in Indian equities. The most redeeming feature this year has been that Indian mutual fund inflows, which now stand at over $10 billion. And it gives us at ET Now great pleasure in the fact that we've made our due contribution. I'm sure all of you have been glued to your television screens and you've noticed the Jan Nivesh initiative, ET Now's flagship investor education initiative, along with the Association of Mutual Funds in India. And we've now hit the 10 lakh or the 1 million milestone, and it's on its way to making its entry into the Guinness Book of World Records, Aisha.
Yeah, it is. And as they say in the market, Savan, that past performance is no guarantee of future returns. So is this the best it can get, or is this just the beginning of an SIP revolution in India? To mull over exactly this, we have with us an esteemed panel of speakers. And to moderate the panel, please welcome ET Now's Managing Editor, Nikunj Dalmia.
When we started the year, it was supposed to be a dream year, but what has transpired has been a year of twists and turns and peak and troughs. Volatility has been extraordinarily high. Now, is risk back or this is volatility? The initial thought is that where is the mutual fund industry headed? Where are the markets headed? We have an election cycle in front of us, and at a time when global central bankers are increasing interest rates, how should one really adjust to the new normal? Nilesh, I want to start the session with you.
Today we have reached 1.85 crore Indians. We are bringing around 8,000 crore by way of regular investment. Mutual fund is no longer Mumbai, Delhi, Kolkata, Madras product. It is there in heartland and rural area. And Nikunj, that would not have been possible without Jan Nivesh and support of entire media industry.
Navneet, belief is fine, but when you lose money, the belief starts shaking. And that's been the story for this year. We started the year on a high note. But when your NAVs have dropped 5 to 15%, 20 to 25% in mid-cap stocks, you said, "Bhaiya, wo sab to theek hai, but jab paisa lagta hai to..."
You have played a very big role in ensuring that people know that mutual funds sahi hai, and sahi hai for a long period of time. Of course, this year, small and mid-cap stocks have gone down, but that's a mirror image of what happened in the previous 3 or 4 years, where small and mid-caps substantially outperformed the large caps. Large caps have done better this year. But over a longer period, I think I've mentioned earlier also, I think one figure that everybody must keep in mind, and I think it's related with our $5 trillion projection also, over the last 25 years, nominal GDP has grown at 13%, corporate profits have grown at 15%, and market cap has grown at 16%, period. I mean, that's the India story. And over a period of time, I think if one keeps the discipline of investing across cycles, when there are down years like this, and there are up years like 2017, over a period of time, you make that kind of money, which is substantially higher than any other revenue. And I think that's the most important message I would like to leave with.
Vikram, should I ask Vikram the investor, Vikram the ex-banker, or Vikram the CEO of NSE?
Your choice. I'll decide which one I want to answer.
So I'll start with perhaps your understanding of what today's agenda is, $5 trillion. It looks like a tall number, but when we were not $1 trillion economy also, $1 trillion also looked like a big number. Now, the challenge has been that Indian economy is growing, but I don't think for an average Indian, the wealth creation has been even in line with what the GDP growth has been. What can be done by an average investor, an Aam Aadmi, so that he can participate in the India growth story?
So fundamentally, I think we've done a lot in terms of investor education. And I do believe that the mutual fund industry has also done a great deal to promote investor education and awareness of mutual fund related products and market risk, etc. I think the mutual fund industry has reached an inflection point where actually if you look at the last 3 or 4 years, the acceleration in assets under management and mutual funds have really gone up quite substantially. And that has actually played a very important role to cushion the volatility in markets. So to answer your question, A, there needs to be a better understanding of markets. B, there needs to be a disciplined investment strategy. C, you need to take a long-term view to investing. And if you follow some of those basic principles, I think investors will certainly create a lot more wealth than they have in the past, where largely a bulk of the assets have gone into fixed deposits, very often haven't necessarily even taken care of inflation. So you do need to have a balanced allocation depending on what your income levels are and what your risk appetite is. So that's what I would say is important.
Sandeep, a very basic question. If I buy a mutual fund, whether it's debt or equity, I'm also buying an underlying risk. What will be a USP to say that FD mat kara mutual fund sahi hai?
I'll say thanks on behalf of the industry as we move towards this $5 trillion. I think from our perspective, the way we see is, this volatility is going to be the name of the game. But I think we have clearly seen the Indian investors maturing. I think at any given point of time, when you see there have been enough instances in the last 20 years when investors, not only you talk the gap of 2%, they have seen negative returns. But if you see over a longer period of time, investors have been making good wealth. And this can be also be seen from the fact that today, the mutual fund industry, while I think in this journey of $1 trillion to $2 trillion as the economy grew, the mutual fund industry has grown 3 times. And I think clearly we believe going forward also, based on the potential that is there. Personally for me, fixed deposits do not remain attractive anymore. I think there is definitely, if you're looking at a very safe thing of 8% is good, but there's no limit, there's no upside. Based on net of inflation, people are actually losing money. But from a long-term point of view, mutual fund and equity mutual funds are the only way people can create wealth for themselves.
Sunil, I guess we don't need to endorse again that as a channel, we are a firm believer on helping Indians reach their financial goals, and we are there to really handhold them to create wealth.
Absolutely, Nikunj. So one thing here is to look at China, because if you look at where China was versus India, in 2007, China was at $2,000 per GDP, which today we are touching at 2.2. In the next 10 years, they went to $10,000. The 5x multiplier. Let's assume a half of that, right? The biggest change is that people may not only spend more, but you have to save more because we don't have a social security net in India which takes care of you post-retirement. So I think the way forward for the country, I think, is that increasing incomes, increasing penetrations will mean that the mutual fund industry will grow much faster than the rest of India's economy. And I think equities come from a response to fear. Equities come with a response to greed, the 2 emotional factors. And I think SIPs is the ideal way where you match the greed factor by controlling the fear by putting it monthly, where you actually benefit from the volatility. So I think in addition to the mutual funds IA campaign, I think the SIPs IA campaign with ET now as champion is a very important thing, that people can come into this asset class, benefit from the volatility as opposed to being frightened and run away.
Nimish, what Nilesh referred to at the beginning was that volatility and risk, they need to be differentiated. You've not shied away in the past from recommending different categories of mutual fund to deal with volatility. What is your view on, in general, volatility, and how can one maximize volatility? Because we have elections, we have central bank policy action. So how does one deal in terms of classification?
Is the simplest thing would be that if you are, because it's an election year, and we believe there is going to be a lot of volatility coming forward, one of the easiest thing that we say is do SIP for the next 1 year. And then whatever is your investable amount, divide it into 12 parts and do it during the year. That is one simple thing. Another, what we have tried to figure out in the last 5 years is that how do we create a dynamically asset management category, and now that category has created. I think that category is what the investor wants. How do we control volatility? Let whatever be the market, he does not have to think, like I said, that we will sometimes say mid-cap is good, mid-cap is bad, etc. He does not have to get into all that. If he does not want to get into all that, then there is a simple thing that just go into a dynamically asset management fund. By that, what I mean that when the markets are high, we ourselves will reduce our equity weightage, and when the markets are low, that will increase the equity weightage. And I believe in the next 3 to 5 years, this category will become bigger than the equity category, because this is what the customer is looking at, low volatility and investment in equity. This serves both the purpose.
Thank you very much. And I'm not saying it, everyone is saying that this is the biggest industry panel which we've had. So thank you very much for joining us, and thank you for your time.
Next week on the India Economic Conclave 2018, we bring to you a power-packed panel discussion on the role of women in a rising India.
Times Influence Initiative.